So can you tell me more about the team behind the investment strategies? Who are they? Like, what's the background experience?
Yeah, so myself, I'm Christian Cole, obviously. I'm the fund manager of the Dominion Global Trends funds. I've been managing the funds now for 6 years. I have a team of 3 other analysts who work with me, a range of experiences. So myself, I've been doing this now for 17 years. I know I might not look that old, but I've been doing it for a long time. Before I was at Dominion, I was at a company called Bernstein, a large American bank. I was researching equities for them. Before that, I was at a hedge fund in America. So I've got quite a varied background. The number 2 on the team, Julia Veresco, she was at JP Morgan before here. And before she joined my team, she was running another fund, a healthcare and financials focused fund. And that's great because my background, I never did financials, I never did healthcare. And we never used to invest in those 2 sectors because, you know, in my view, if you're going to invest in a sector, you need to understand it. Mm-hmm. Healthcare is very complicated, financials is very complicated. So Julia is fantastic because she brings the expertise of financials and healthcare to the team as well. And now we're investing in those sectors too. You know, one of the investments we have today that we're most excited about is a healthcare investment. We wouldn't be investing in it if it wasn't for Julia being on the team. So she's been a real strength to the team. And then we have 2 junior analysts, James and Aurimas. Aurimas has been working with me personally. He joined us 5 years ago. His first job in finance, I've been training him from the ground up. Okay. He's learning the ways, you know, the Christian Cole and the Dominion ways of investing, which is fantastic. He's doing great. And James is a little bit more experienced, but still junior. He joined us, about a year ago. He comes from Bank of America, very experienced. He's an accountant as well. So you can see just the direct team, very strong, very, very strong. And then we also have the power of Pacific Asset Management behind us as well, which is 60 staff members, yeah.
Amazing, amazing. So what is the core investment philosophy that guides your asset management approach?
Yes. It's very simple in practice, but to do it is difficult. But the idea is simple. We want to buy really high quality, growing businesses, but we want to buy them cheap. We want to get them cheap. That's a critical thing for us. We want high quality, growing companies, but we don't want to overpay for them. We want to buy them at attractive valuations. That we think is the way to get good returns in the long term, but also really important, good risk adjusted returns, right?
Okay, so Christian, many professionals in Latin America believe they can learn to trade through an online course, a program, and manage their own investments themselves. From your experience, your perspective, what are the key differences between retail trading and a professional portfolio management?
It's a really good question. Not everyone I know works in finance, right? Friends, family, most of the people I know don't work in finance, and they often ask me similar questions to this. And my advice is always the same. I will never tell anyone, don't do something. If you want to go and learn, go and learn. If you want to do some trading yourself, do some. But be very, very careful. Very, very careful. There's a reason why professionals do this for a living. You know, I've spent 17 years doing this, and I'm still learning, right? It's very complicated. And so my advice to retail investors is if you want to do your own trading, you can do some, but be careful. It's more risky usually than you think. It's not something you can learn to do professionally very quickly. It's something you should really rely on at least some advice from professionals. And if you're going to do it, don't do it with all of your money. Do it with a little bit, right? It's like there's lots of things you can do a little bit with your money, but don't do it with all of your money. Rely on a professional for most of your savings if you're going to do this, and maybe a little bit of your money on the side as a way to learn.
Excellent.
I think. Yeah.
Excellent. So in that point, what is the difference between investing in a regular ETF and investing in a mutual fund?
Well, the difference is it a computer investing for you or a person, right? So if it's an ETF, it's automated, right? So you're investing in the market. If you buy an S&P 500 ETF, you're buying the S&P 500 index, right? The ETF, the fund, is replicating the performance of the market, right? a mutual fund or a fund like ours is active, which means there's people making decisions, right? And so sometimes our fund might underperform the market index, other times it might outperform. Our job, on average, is to outperform. That's why if you want to put money into a mutual fund, you're really taking a view that you think they can do a better job than an ETF, right? And that's our job. And again, it goes back to what you asked me before about the investment philosophy,
Exactly.
right? You know, we think the way to beat the market, to get better returns than the market, is to invest in a way where you're minimizing risk, valuation, low valuation, but you're maximizing the upside, high quality businesses which are growing, right? But that's fundamentally the difference. I think there's a place in, I may be answering the next question, but there's a place in portfolios for both. I never argued never ETF or never mutual fund. I think a proper portfolio is a mix of some market exposure through ETFs, because you want to have that long-term exposure from ETFs, but also you want some of the differentiation that comes from exposure to mutual funds, active funds like ours, because we're doing something different. Doesn't mean we're underperforming or outperforming, but on average, you want your mutual funds to be delivering something different to your portfolio. And so I think there's a place for both.
So in that point, how does working with an experienced asset manager provide a different outcome in terms of risk, strategy, and long-term wealth creation?
Yes. Well, that's the critical question, right? Yeah, that's the critical question. So, well, first of all, you want to be able to prove it. You got to show with numbers, and so that's something we can do. So what we show many of our investors and potential investors is the long-term performance of the fund compared to the market index. So, for example, we're global investors, and so the equivalent ETF would be MSCI World for us.
Okay.
And if we look over the long term, we outperform the index in absolute terms, so we just have better performance. But we do it with less risk, right? Because it's both, right? It's risk and return, right? So it's possible to get lots of return, but you're taking lots of risk. That's dangerous, right? And so the game we're playing as investors is we want to have good returns, but with lower risk, if possible. And so and the way we measure risk is volatility. Lower volatility is better, right? And so we have lower volatility typically than the market, but higher returns.
Exactly.
Right, and that's what you want. You want higher returns with lower volatility. So I think, personally for our fund, that's what we're doing, which means, and that's the value for investors' portfolio. So what that means for your portfolio is you might have some ETFs, S&P 500, NASDAQ, MSCI World, but then if you've also got exposure to a fund like ours, which is different because the companies that we're investing in are different to what's in the index, and we've got better returns than the index and lower risk, that means your portfolio overall, even though you still own S&P 500 ETF a little bit, because you've got us in that portfolio as well, your whole portfolio will be offering you better returns and lower risk. And that's the value of having someone like us in your portfolio.
Nice. So if you could give one piece of advice to a professional or a business owner in Latin America,
yes,
who wants to build long-term wealth, what would it be?
This is a great question, and somebody asked me this question on a beach.
Okay.
I was with my friends in Scotland, Scotia, and we were on a trip. And none of my friends there work in finance, and one of them asked me, "What if you could give one big piece of advice for me as an investor? What's the most important thing to learn?" And I thought it's a great question because no one ever asks you that question really. What's the most important thing? And I thought about it for a while, and I said to him, we had a fire on the beach, we were kind of chatting, having a beer, and I said to him, patience. And I thought about it afterwards, and I was right. That's the key thing. It's patience. You've got to think about the long term, right? If we were talking about trading before. If you're trading too much, if you're worried about the latest news, tariffs, war in Ukraine, markets down, markets up. If you're focusing too much on the short term, you can make mistakes. The by far and away the best thing that you can learn as an investor is think about the long term. And what that means is you've got to invest and stay invested. If you're taking money out, putting money back in, trading too much, historically, it doesn't work. Even the professionals, we make mistakes when we do that, right? We've just learned it now with the Trump tariffs. We had markets down, 15%, and then back up again 15%. And now markets are up. Our fund is up 6% this year. The right thing to do was nothing.
So that's the mindset that you should have in all of...
Remain invested. If you're putting money to work into international markets, into equities in the US, or into a mutual fund like ours, we're investing in businesses, right? And businesses take a long time to grow, right? It's not 1 month, 3 months, 6 months returns. It's 5 years, 10 years. That's when you get incredible returns. And by far the best investors historically, like Warren Buffett, right? The reason they did so well is because they were patient. They waited. They invest in a company they know is a good company, and they wait. Let the company do the work for you, right? And then the returns will come. They will compound over time. Okay.
With all the noise around the tariffs and the global trade, many investors feel like anxious, like, oh, what's going to happen? Volatility and all of that, like uncertainty. So in times like this, what is the mindset to approach, but you already said like...
We could, maybe there's one thing I didn't mention on that, so maybe we can talk about that. So I think, patience, again, be patient, think long term. But maybe we can talk about the tariffs thing. What did we do during this period, right? So markets were down 15%, very scary, volatility, one of the biggest volatility spikes in terms of VIX in the last 15 years. So it's scary times, right? And people were legitimately worried about the economy, etc. So what did we do, right? So the first thing we did, we didn't sell anything. We didn't sell because it's too short term. And the reason we didn't sell is we look at every company we own and we think to ourselves, in 5 years' time, in 10 years' time, is what's happening now going to affect that business? Is the business going to be smaller in 5 years' time, or is it going to keep growing? And we're looking at healthcare companies, we're looking at technology companies, AI companies that we own. And we look at, and we think, well, tariffs, yeah, they might be bad, but in 5 years, these companies are going to be growing and they're going to be bigger. Of course they will. They're going to be. We know these companies so well. And that answers the question for us. Don't sell them just because there's some tariffs. It's fine. It's fine. The next thing we do is, markets are now down 15%. And for some stocks, the share prices were down more. They were down 30%, right? And again, you ask yourself the question, is that company that's now worth 30% less, is it going to be bigger or smaller in 5 years or 10 years' time? Are they still going to, for example, we own a company that in the UK that makes components for aircraft, commercial aircraft, right? Engines, right? One of the best technologies in the world, right? Every engine on the planet, aircraft engine, the aircraft that flew you guys here to London, the aircraft that flies me to Latin America and I go there, all of them use this company's components, right? 30% down in a month because of the tariff news. We look at it and we think, is the world going to stop flying on planes? No, it's going to keep growing and keep growing. But we can buy the same company for 30% less. So if anything, we're buying. So we're not selling, but we're thinking about buying. That's the critical thing during times like that. And I think it's really good for investors if they are going to try and play these events when they happen, because they always happen, right? If it's not tariffs, it's pandemic, it's recession fear, whatever. There's always something, right? If you are going to play that, first of all, be patient, don't sell. But second, think about buying. When everyone else is selling, when there's red on the screens and everything's selling and everyone's panicking, you should be thinking about buying, because you can make the best investments of your life if you're buying at the lows. And that example I gave you is back up 30%. So we were buying that UK, it was a UK aircraft component company, fantastic business, 30% off, didn't make sense, we buy it, the share price is back up 30%. So in 1 month, we make 30% return. Do you know what I mean? And so I think that way of navigating is really important when these crises come, because they always happen. And it's always a different crisis every time, right?
Yeah, so it's like an opportunity.
It's opportunity, yeah. You know, the Chinese, they use the same word for crisis and opportunity. It's the same word. And that's the way and it's hard to do it in practice because when the markets are down, tariffs or whatever, recession is scary, but it's really good for you as an investor if you can turn it around the other way and think differently. And that's exactly what we do. It's our job. Right? It's our job to think differently, and that's where our value comes in. And so when we get stuff like the tariff thing, we're thinking about buying. So we're looking for opportunities to buy. And we were doing it last month, and already some of these investments have made us like quite a bit for the fund.
Excellent.
Nice.
Thank you, Christian.
Okay.
Thank you.
Awesome. Cool.
Thank you so much.